सुभाष नागरे एक आदमी है, सरकार एक सोच।
एक्चुअली सरकार कोई सोच वोच नहीं है. In fact, the government of India is by far the single largest shareholder with more than 21 lakh crores of market value in 74 listed companies. Many of these are monopolies, and there are a further 100 plus companies that are owned by the government and are yet to be listed on a stock exchange. Now, the popular line in support of investing in a public sector enterprise is that these companies are backed by the government and are therefore less risky. It's something many investors, especially beginners, talk about, but in this video, I'll be putting forward a case on why one should in fact be extra careful when investing in a PSU and the hidden risks that are involved. Let's begin. So there are three things you would generally associate a PSU stock with. Firstly, since they are government backed, there is always that implicit guarantee that the Sarkar won't let them fail. Number two, these stocks are almost always attractive in terms of their P ratio. And thirdly, many of them pay a reasonably generous dividend. Outside of these statistics, many public sector companies have confirmed contracts from the government, they have a large asset base, the competition is almost zero, and let me not even talk about the current market value of the massive land parcels that each of these PSUs hold. And while everything seems a bargain, in my view, a lot of it is actually a trap. I mean, just look at the Nifty PSE Index, the Public Sector Enterprises Index. Since the turn of the century, it has delivered a CAGR of 8.9%, and if I add, let's say, a 3% dividend to it, then it comes to almost 12%, which is a tad lower than the 12.6% that the Nifty 50 has delivered. The recent numbers are even worse, with the PSE index clocking a 5-year CAGR of just 8.3%, and that's including dividends, while the Nifty 50 has delivered 12.9%. In fact, the share price returns of more than half the companies within this index has been lower than the standard inflation rate of 6%, and barring a few of them, public sector companies generally underperform the market. I'm sure we can all deduce why this is the case, but incidentally, what gets hidden in this entire setup are some of the glaring risks that we as investors face, which is what I really want us to understand in this video. The first big risk is a change in policy and what's potentially happening with IEX. The Indian Energy Exchange Limited is a good example of that. To put it simply, IEX is like a big online bazaar for electricity. So essentially, power plants, if they have a surplus with them, they can sell this electricity to businesses, companies, and people who have a need for it. But because this process is a bit complicated, that's where a platform like IEX comes in that matches the bids and offers, allows some kind of price discovery, and facilitates the trade. Now, it seems the Power Ministry has directed the Central Electricity Regulatory Commission to form a single government-owned power trading entity, which is a problem for IEX because it takes away the price discovery on which IEX had a virtual monopoly, and now IEX might become just an aggregator which paves the way for more competition. Of course, that's what the market thinks, and consequently the company's share price fell by 18% in just 2 days. My point is, companies like IEX, which are actually not owned by the government of India, but because they are dependent or are tacitly controlled by the government, they will always face an existential threat due to a change in policy, and as a smart investor, you will do well to factor that in your investment thesis. A second risk we investors face when investing in a PSU is a sudden change in formula by the government. I mean, it's like that dialogue in Sarkar.
मुझे जो सही लगता है मैं करता हूँ.
But what Sarkar in this case really means is that मुझे जो अपने लिए सही लगता है मैं वही करता हूँ. For instance, in the case of LIC, a report in their own red herring prospectus said that LIC's embedded value as of March 2021 was 95,000 crores. But then just before the IPO, so say 6-7 months later, the very same embedded value number was now reported by LIC as 5,39,000 crores, which is a jump of 460%. Now, I've explained what embedded value is and how to value a life insurance company in a separate video. But simply put, an EV represents the present value of all future profits expected from existing policies, which gives us a ballpark number of what the insurance company is worth today. It's a very important number, and the bigger it is, the more valuable the IPO becomes and higher will be the government's collection from it. So what did the Government of India do? Well, it made a quick amendment in the Life Insurance Corporation Act to capture the difference between a participating and a non-participating fund. And while it's a bit technical, what this change in formula really did is that it added an additional 4.1 lakh crores to LIC's embedded value, paving the way for a successful IPO. Although I'm quite sure the public shareholders of LIC don't look at it that way. Another related example is what happened in 2018 with Bharat Electronics Limited. So the Ministry of Defence would offer contracts to BHEL for execution, and the company was paid a gross margin of 12.5%. But then in September of 2018, the ministry announced a revised structure, and what was a PBT margin of 12.5% was slashed down to 7.5%. 12.5 to 7.5 is a 40% drop, and understandably that's how much the share price fell over the next 1 or 2 weeks of that announcement. The point is, in both these cases, the government did something to suit their interest as a majority shareholder, which means as a much smaller investor, it's our responsibility to have a better understanding of the risks when investing in public sector companies. Now, the Government of India has equity in many listed and unlisted companies. But what we often ignore is that many of these listed companies have a number of unlisted companies within them. For example, the State Bank of India has a bunch of unlisted companies or investments, and most of them have something to do with their core business, and therefore there is some synergy there. But then I also came across an unlisted company, Ramagundam Fertilizers and Chemicals Limited, which was inaugurated last year by Prime Minister Modi himself. So this company, RFCL, is a joint venture between three entities: National Fertilizers Limited, the Fertilizer Corporation of India Limited, and Engineers India Limited. Now, you don't have to be an engineer to figure out that EIL is the odd man out, and a company that provides engineering consultancy and EPC services for the oil and gas sector has obviously nothing to do with fertilizers. But EIL has a peculiar problem. It has a lot of cash, and when you have cash, then there is always someone there who will try to squeeze it out of you. So that's what I think happened here, and EIL ended up investing 491 crores for a 26% stake in RFCL. Which means if you are a shareholder in EIL, then there are three things that have happened which should concern you. One, EIL has entered a business, or at least invested in a business that it doesn't understand. Two, it paid almost 500 crores for part ownership in a non-core business. And this company, Ramagundam, well, it closed FY22 at a loss of 759 crores, which means EIL with its 26% stake takes in a loss of 203 crores. My point is, I think this Ramagundam company ko inke paas thop diya gaya hai, and this might be happening a lot in government companies. So as investors, we have to be careful and aware of such risks. The next area one has to look for when investing in public sector enterprises is its execution ability. For instance, Bharat Electronics Limited was labelled as a Maharatna until about 10 years back. And the numbers really supported that, with growing sales, growing profits, and an increasing order book. But since 2013-2014, the company has declined on most parameters, which has taken a heavy toll on the share price as well. The root of the problem was and is the company's poor project execution, which led to multiple issues like lower margins, a higher working capital requirement, delays in making and receiving payments, etc. So a couple of learnings here from a retail investor's perspective. One, having a massive order book means nothing if the company is unable to execute it. And secondly, and especially with companies like BHEL, it's important to keep a close eye on certain operating efficiency metrics on a quarter-on-quarter basis. Also remember, every sector will have its own nuances. So for example, if we are examining public sector banks, then one will have to assess the net interest margin, the provisions, the deposit growth, the loan book, the CASA, the NPA, etc., which are major operating efficiency parameters for the banking sector. A fifth risk that doesn't show up if you only examine financials is the loosening of priorities. What do I mean by that? Well, look at it this way. Suppose you are invested in a company and you're watching an interview on TV where the newly appointed CEO says, "Did you say profits? Well, my role is to give jobs to more and more people. I love giving big increments to my staff, and I like keeping my customers happy. I don't care about profits. That's not my priority." Now, as a shareholder, I'm sure you won't be happy about this, but that's pretty much how a lot of public sector companies operate. For instance, whenever there is some shakeup or some bailout is required in the financial sector, then the State Bank of India and LIC are expected to pick up the pieces. Now, if SBI and LIC were 100% government-owned companies, then it's still fine, but when there are people like you and me who are also part owners, then we are actually getting a raw deal, because our priority of receiving a good return on investment is being substituted for something that we had not signed up for. In fact, lately I've been seeing this increasing trend of the government dictating or rather demanding actions from their listed public sector undertakings. For example, in April this year, the Gujarat government, the state government, announced a proposal wherein companies where they have a majority stake, well, those guys have to comply with some provisions concerning the amount of dividend, buybacks, bonus shares and a stock split. Understandably, the state government has their own interest at heart, as it either wants to command a higher valuation in the market when offloading shares, or perhaps they want to use the higher dividend and buyback amount to meet their own budget requirements. Whatever be the intent, one thing we can all be sure of is that the government's priorities and our priorities with respect to capital allocation are not likely to match, and we have to be super careful of those public sector companies where this mismatch is pretty divergent. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Another risk when dealing with largely government-owned companies are management incentives or the lack of it. You see, more often than not, it is either greed or fear that drives the management to push harder. Let's start with fear, and in the case of public sector companies, firstly, no one is worried about losing their job. And secondly, since most of the managers don't have a stake in the company, there is no reason for them to truly care about the shareholders' interest. Now, when it comes to incentives, I think it's even more lopsided. And a good example of that is the State Bank of India chairman, who takes home an annual salary of just 37 lakhs, while his counterparts in private banks make anywhere from 6 to 8 crores. To put this in a phrase, most public sector enterprises work with a wrong set of incentives and an equally wrong set of disincentives. And the final area of concern is information, and I've kept this as a separate point because in modern day investing, information has a lot of value. Now, unlike their private counterparts, the information coming out of public sector companies is less frequent and highly curated. What I mean is, while you'll find PSUs publishing financial statements, annual reports, disclosures, etc., because it's required by law, what you won't find are many interviews by the CEO, a lot of coverage by equity analysts, articles in business journals, and I generally feel there's an air of secrecy on how a PSU conducts its business. The point is, a lack of public scrutiny is actually bad in the overall scheme of things, and while this might suit the PSU, it's obviously not very comforting for retail investors like you and me. Right, so how should a retail investor look at all this? Well, firstly, from a buy and hold perspective, at least the data says that investing in a portfolio of PSU stocks doesn't really make sense. It doesn't make sense on a performance basis, not from a volatility standpoint, and not even in terms of dividends given the unfavorable taxation structure. Which means the other alternative is to look at PSUs from a return and risk perspective. Now, given the regular market risk and what we have discussed in this video, for someone like me to invest in a PSU, it would require that the stock offers me a chance of earning superlative returns, which should definitely be in the 30, 40, 50% range. Are such high returns possible? Yes, they are very much possible given the fact that most non-banking PSUs operate in a cyclical sector which often see big spikes and big falls from time to time. So it's a tactical call, a case of timing the market, which I'm not personally comfortable with, and that's perhaps why I myself avoid investing in state-owned or government-influenced companies. In my view, there are a number of other companies and dozens of opportunities which can definitely take a precedence over investing in public sector companies. So at least that's what I think, and if you have a counter view or if you even agree with me, then do let me know in the comments box below. I sincerely hope you will utilize what you have learned when you next evaluate a public sector undertaking, and if you aren't a subscriber yet, then do explore subscribing to my channel. Thank you for your time, and I'll see you 3 days from now. Until then.